Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that is all about extending a loan and getting a little something extra in return. Let's just say some deals are better when they're not rushed. Before we dive in, make sure you hit that subscribe button because we break down these complex financial documents so you don't have to. Also join our Discord community, linked in the description below, for even more insights and discussions. This is a Form 8K, which is basically a report for big news or events that a company has to tell the public about. Think of it as a special bulletin for investors. The main event here happened on the 28th of October 2025, and it involves a company called Unite Acquisition 2 Corp. Now, they're not exactly a household name like Apple or Google, but they are involved in the business of acquiring other companies, often called a SPAC, or Special Purpose Acquisition Company. So Unite Acquisition 2 Corp made a deal to push back a deadline on a loan. They had a promissory note, which is just a fancy way of saying a loan, that was due to mature or come due on the 28th of October 2025. But they entered into an agreement called a First Amendment to Promissory Note. This basically means they agreed to change the original loan terms, the big change. They extended the maturity date of that loan from the 28th of October 2025 all the way to the 28th of October 2026, so they bought themselves another year to pay back this debt. The lender in this situation is Lucius Partners Opportunity Fund. LP, it is important to know who is loaning the money, because their willingness to extend the deadline is a key part of the story. Now, here is where it gets interesting. For agreeing to extend the payment deadline, Unite Acquisition 2 Corp didn't just get a handshake. They had to give Lucius Partners Opportunity Fund, LP, something valuable in return. They issued a warrant, which is essentially an option to buy 30,000 shares of the company's common stock. This warrant has an exercise price, meaning the price at which they can buy the shares of just 1 cent per S-share. That is super low, and this warrant expires on the 28th of October 2028, giving the fund a good chunk of time to decide if they want to exercise it. This is a classic SPAC move. When you are a SPAC like Unite Acquisition 2 Corp, you are essentially a shell company looking for a target to merge with. If you are running out of time to make a deal or need to extend your own financing, you often have to offer up equity or ownership in your company to get those extensions. Essentially, they're giving up a piece of their potential future company to survive in the present. So this warrant agreement and the amendment to the promissory note are the key documents here. They show the company is actively managing its debt and financing, even if it means giving away some future ownership. It is also worth noting that Unite Acquisition 2 Corp is an emerging growth company. This means they are a relatively new public company and can take advantage of certain regulatory flexibilities. Here, they've checked the box indicating they are an emerging growth company. This filing is pretty straightforward. It is not packed with pages and pages of financial statements like a quarterly or annual report. Mostly, it is about this one material event, the loan extension and the warrant issuance. The report is signed off by the Chief Executive Officer, Nathan P. Pereira. This is standard procedure for these filings, confirming the company's acknowledgement and reporting of this event. So, what is the story here with Unite Acquisition 2 Corp? They're a SPAC, and like many SPACs, they're facing the clock. This filing shows they needed to extend a loan, and to do that, they had to give the lender a piece of the pie through warrants. This is a common strategy to buy more time, hoping to find a merger target and create value. However, issuing warrants dilutes the ownership for existing shareholders, meaning their percentage of the company decreases. The low exercise price of the warrant also suggests the lender is expecting the company's stock price to significantly increase if they decide to exercise it. The risk for Unite Acquisition 2 Corp is that if they can't find a suitable acquisition, or if the existing shareholders aren't happy with the dilution, things could get tough. It is a gamble to extend and hope for the best, but it is also a necessary move for many SPACs trying to stay alive. What do you think about this loan extension and warrant deal? Does it signal a company making smart moves to survive, or is it a sign of trouble ahead? Let us know in the comments below if you found this breakdown helpful. Please give it a thumbs up and subscribe for more corporate insights. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next one.